In this video, I am going to share with you the latest business update from Parkway Life REITs for Q3 2024. Let's get into it. Hey friends, welcome back to the channel. I am Iggy here, and I've been covering topics such as stocks, finance, CPF, and everything related to growing your wealth. The investing Iguana is featured and ranked 8th in the 2023 Influential Tigers by Tiger Brokers, with over 800,000 reads. I've covered over 500 videos and over 250,000 watch hours as of September 2024. Let me break down the Q3 2024 results in a way that matters to you as an investor. The gross revenue showed a 2.2% decrease, landing at 108.5 million Singapore dollars. Now, before you get worried, this drop mainly came from the weaker Japanese yen, not from any fundamental business issues. Think of it like this: when you exchange Japanese yen for Singapore dollars, you're getting less than before. But here's the smart part: P Life REITs saw this coming and put protective measures in place. What's really interesting about these results is how they managed to grow their distribution per unit despite the revenue dip. This growth happened because of three key factors. First, they hedged their Japanese income. Think of it like having insurance against currency fluctuations. Second, their Singapore hospitals are performing well with built-in rent increases. Third, their Japanese nursing homes have step-up lease arrangements that guarantee higher rents over time. The REIT's balance sheet looks rock solid, and I'll tell you exactly why this matters for your investment. They're maintaining a remarkably low debt cost of 1.36%, which is significantly lower than the current market average of around 3 to 4%. Their gearing ratio sits at 37.5%, well below the regulatory limit of 50%, giving them plenty of room for future growth. Let's dive into their latest acquisition, a brand new nursing home in Osaka. They snagged this property for 20.7 million Singapore dollars, which was 9.1% below its market value. Let's put P Life REIT's portfolio into perspective. This impressive portfolio comprises 64 properties worth a staggering 2.24 billion Singapore dollars. What's more, these aren't just any properties, they're essential healthcare facilities that provide critical services to communities. Strategically located across Singapore, Japan, and Malaysia, these properties are a vital part of the healthcare infrastructure in these regions. One of the standout features of P Life REIT's portfolio is the average lease term, which stands at 15.83 years. This is significantly longer than most REITs in the market, providing a stable source of revenue for the company. Furthermore, an impressive 98.5% of P Life REIT's revenue has downside protection, which means that the company is well insulated against market fluctuations. In terms of revenue streams, Singapore is the largest contributor, accounting for 63.5% of the gross revenue, while Japan contributes 36.3%. Notably, Parkway Hospitals Singapore is P Life REIT's biggest tenant, accounting for a significant 63.5% of revenue. This diversification of revenue streams and long lease terms provide a robust foundation for P Life REIT's growth and stability. P Life REITs is taking a proactive approach to growth, pursuing three strategic pathways to expand their presence in the healthcare real estate market. Firstly, they are intensifying their focus on Singapore and Japan, where they already have a solid foundation, to further solidify their position in these markets. This strategic move allows them to leverage their existing expertise and resources to drive growth in these regions. Secondly, P Life REITs is actively exploring entry into a third key market, which has the potential to unlock new opportunities for expansion and diversification. This forward-thinking approach demonstrates their commitment to continuous growth and adaptability in an ever-changing market landscape. Thirdly, P Life REITs is cultivating strategic partnerships with local operators who possess in-depth knowledge of their respective markets. By forming these alliances, they are positioning themselves for potential future deals and collaborations that can drive growth and enhance their portfolio. This calculated approach echoes the strategic thinking of a chess player, always planning several moves ahead. By concentrating on specific regions and partnering with quality local operators, P Life REITs is building scale and reinforcing their position as a prominent player in the healthcare real estate sector. P Life REITs is demonstrating remarkable resilience in the face of challenges posed by currency fluctuations, a testament to their robust strategies and effective management. Their hedging strategy is paying off, successfully shielding income from the adverse effects of currency volatility. Moreover, they continue to identify opportunities to expand their portfolio, showcasing their ability to adapt and thrive in a dynamic market environment. A key factor contributing to their stability is the long lease terms and high occupancy rates, which ensure a steady and predictable income stream. This is a highly attractive feature for investors who value the assurance of consistent returns. Furthermore, P Life REIT's financial position is equally impressive, with a low debt cost and a strong interest coverage ratio of 10.2 times. This not only provides them with the flexibility to pursue future acquisitions, but also affords them the capacity to weather any potential economic headwinds. With their solid financial foundation and proactive approach to growth, P Life REIT is well positioned to continue delivering value to their investors and cementing their status as a leading player in the healthcare real estate sector. What's truly thrilling about P Life REIT's future prospects is their strategic focus on healthcare properties and aging societies, a demographic trend that's unfolding across various regions. Singapore, for instance, is bracing for a significant surge in its elderly population, which is projected to double by 2030. Meanwhile, Japan is already grappling with the challenges and opportunities presented by being the world's oldest society. P Life REIT's proactive approach to capitalizing on this trend is impressive, with a series of strategic acquisitions in Japan's nursing home sector that have bolstered their presence in this critical area. Furthermore, their strong foothold in Singapore's premium healthcare market, where demand for high-quality medical services is skyrocketing, provides a solid foundation for future growth. By zeroing in on this specific niche, P Life REIT is poised to reap the benefits of an aging population, as the need for healthcare services and facilities is set to escalate in the coming years. This forward-thinking approach demonstrates their ability to adapt to changing demographics and position themselves for long-term success. As the demand for healthcare services continues to grow, P Life REIT's strategic focus on aging societies is likely to yield significant rewards for investors. If you found this analysis helpful, you're going to love my next video where I break down OCBC's recent buy rating on Parkway Life REITs and explain why they set a target price of $4.48. Hit the subscribe button and click the notification bell so you don't miss it. Also, drop a comment below letting me know what other REITs you'd like me to analyze next.